Hello everyone, welcome back to my channel. Today's video is just going to be a quick follow-up on a previous video that I posted. It was about 3 months ago when I was showing a trading position on Nike. Now, since then, Nike has had a very bad earnings call. They offer a poor guidance and the stock has just dropped significantly. So my calendar spread, even though the short position expired out of the money, the long position it is down significantly in value as well. So what do you do in that case? What do you do when you are trading with some options that are in the money or barely in the money or even out of the money and then the stock position just drops significantly? Well, in today's video, I'm going to show you how I manage that type of situation. But let's go back to the beginning. Let's talk about the objectives of the strategy. If you had followed previous videos that I posted in my channel, and if you have followed me with the strategy overall, you know that my objective is to use options to be able to buy the asset itself. So in this case, if I'm trading Nike options, then I want to purchase stocks of Nike, of the same company. And how I'm going to accomplish that is by continuously trading options for that same asset, for that same company. And basically what I'm doing is I'm doing either calendar spreads or debit spreads using just call options. The strategy is very simple. I buy a call option that is going to expire farther out in the future, that it has some value, that is as close as possible at the strike price. And then I sell short call options against it. Normally, I don't go much farther than, say, 3 weeks or 4 weeks. So I'm always trying to manage that position and be as close to the strike price as possible. However, in this case, like I said before, the stock price had dropped significantly. So what do I do in this type of situation? Well, for once, it's not all loss, right? I still have the long position. Let's remember that that long position was at a strike price of 87.5. So that is now out of the money. And it's out of the money by, at the moment, about $10. So the stock price have basically been down significantly since I moved into this position. However, because this call option here, and I'm showing you the strike price of 87.5, because this call option expires in March 2025, I still have a lot of value left in it. If you see, the price is trading currently at about $423. And this varies a lot. Obviously, the stock price increases, this position will increase as well. And if the stock price decreases, this position will continue to decrease until either expires out of the money or close to the money as we approach the expiration date. So what do we do in this case? Well, like I said, not everything is lost. If my objective is to be able to buy stock options with this position, then if I was willing to pay $87.5 per stock, now as I go down in strike price, meaning if I get closer to what the stock is trading now, then that's going to be a lot cheaper for me. So let me show you. Let's say, for example, I sell the call that is at 87.5 in strike price, and then I buy the 85 strike call. So basically what I'm saying here is that I'm willing in the future to buy the stock price not at 87.5 but at $85. And because I'm improving that cost, that strike price for which I'm willing to buy the stock, I have to pay something. In this case, I had to pay $82. But what you have to pay attention to is that instead of paying 87.5 for 100 stocks, I'm going to pay $85 for 100 stocks. So basically, in the future, I am saving myself $250. And this is how I look at this type of strategy. Obviously, if I go down, say I want to buy the stock at $82.5 in the future, I am going from 87.5 to 82.5. And that's gonna cost me $1.75 per stack, or $175, $173. But I'm not gonna pay those extra $500 because I'm improving my cost basis by by a dollar amount that is much beneficial to me. Okay, so if I continue to go down, obviously that is going to become more expensive. But because all of these strike prices are out of the money, they are not that expensive if if my conviction is that the stock price is going to recuperate. And because that is my overall conviction, then I am willing to improve the strike price of my long call position. Okay, so how much I'm going to improve, it just depends on my risk tolerance. In this case, and that will be on a case-by-case basis, but in this case, I am willing to decrease my strike price to $75. Again, I am improving the long portion of my strategy and moving from a strike of 87.5 to a strike of $75. Now, if you see this call, even though expires on the same day, it is now trading in the money. So it's going to be much more expensive, but I'm going to be using some of the value that I already have on the call. And overall, the cost is going to be $535 for that move that I'm going to make. All right, so now your question might be, this is all good, but how am I going to afford that $533? I don't want to put any more money into this strategy. Well, simply, we're going to look at selling call options against these in order to be able to pay for this cost. And I'm not going to do it just week by week, or I'm not going to do it just little by little. I want to cover this cost here and now at this moment when the stock is trading at this price specifically. So what I will do is I will look at to sell another call, and I will go closer to an expiration date of, let's say, October. Now let's remember we're now mid-September, so I'm looking probably mid-October. Now, if I see here the calls, once I get into the in the money position, they have a lot more value. Well, look at this, the $75 strike price, it is currently trading at $580, or $5.80 per stock. So if I sell that position, then that more than enough give me more than enough money to cover for that cost of improving my strike price on the long position. Now, if you don't feel so comfortable with that, you can go higher, and you can see that you're going to have a little bit of a cost, but it's not going to be that $500 that you have to pay. In my case, because I don't want to put any more money into this position, I just want to manage it going forward, I'm going to be selling the $75 call against it. And because I am buying the $75, I can easily just sell $75 call in the future, and just continue rolling those up or farther out as the stock progresses with prices. All right, so there you go. That is, in a nutshell, the strategy. I am basically taking advantage that the stock price have decreased a lot. This company might go down a little bit more. We don't know, might stay flat, or it might go up. Whatever happens, I am going to manage, or my job is to manage the short position. If the stock has a good earning calls going forward, then it might go up in price. I just gonna try to manage this short position, so I start continuously building that credit spread between the $75 call and whatever strike price I am rolling to in the future. But if the stock continues to be flat, then I am going to keep this value of the call option that I'm now buying. And that is what I'm doing. If the stock price goes down, then I'm just going to continue doing the same thing that I'm doing right now until eventually I can accrue enough premium that I can just exercise my long position. All right, with that, thank you so much for watching, and I will see you on the next video.